Hi, I'm John Rosenau, Vice President and Chief Operating Officer of MONECO Advisors. Welcome to MONECO's monthly market update presented by MONECO Advisors here in Fairfield, Connecticut. Today we're going to discuss the major headlines that influenced financial markets in late 2016 and provide insight into what these developments could mean for you as an investor. Please watch until the end of this video for a required disclosure statement. In the final trading days of 2016, we see the post-election market rally-com. As all three major indexes posted losses for the week of December 26th, despite this dip, the S&P 500, Dow, and NASDAQ were each up at least 2% overall in December. As for the entire 2016 fiscal year, the S&P was up 9.5%, the Dow 13.4%, and the NASDAQ was up 7.5%. But what led to the most recent increases in the stock market? Arguably the biggest economic event we experienced last month was the Federal Reserve's much anticipated interest rate hike. On December 14, the Fed raised the benchmark rates by 0.25%, which only marked the second time they've increased rates since 2006. Fed Chairwoman Janet Yellen explained that her group's decision reflected the economy's progress and their expectations for continued economic development. The Fed also indicated that they might introduce 3 additional interest rate increases in 2017, up from their previous prediction of 2. The financial markets had a moderately subdued reaction to this announcement, unlike the intense market volatility after the rate hike in December 2015. In fact, the VIX, a main volatility measurement, ended 2016 32.2% lower than where it began last January, despite a small dip in December. Ultimately, rising interest rates are a sign the economy is growing. Last month, we saw several indications of this growth, including the final report on the third quarter GDP. In the Commerce Department's analysis, they adjusted the GDP up to a 3.5% annual rate, showing the fastest economic growth in 2 years. Consumer sentiment and consumer confidence also were up, both reaching levels not seen in many years. Consumer sentiment, which measures consumers' views on the current and future state of the economy, reached its highest reading since January 2004. Measures of consumer confidence also hit a 13-year high, indicating that people feel more positively about business conditions, employment, and family income. In addition to these positive signs, we saw the dollar hit a 14-year high on December 20th and end the year up 3.8%. Crude oil also continued to recover as investors anticipate that OPEC and other producers will begin to reduce output in 2017. But of course, positive economic indicators do not mean that everything is perfect in the economy. Data released in December showed decreases in durable goods orders, industrial production, and housing starts. We don't like to see these declines, but the biggest economic question marks may not come from existing data, and instead from changes in our political leadership. Stocks have rallied on hopes that President-elect Trump will reduce regulation and taxes while increasing infrastructure investment. But no one knows for sure what changes could be on the horizon or how Trump's policies will affect trade. As we begin 2017, we will closely watch economic data and political environments and keep you updated. Stay tuned for next month's video update, where we'll have annual data to discuss. Thank you for listening to this month's update, and we welcome you back next month for more professional advice from our family to yours. Please remember that nothing we talk about here is a recommendation, and if you would like to discuss your personal financial situation, please contact us. Take care. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results.